For every $100 that you earn, you tend to lose $8.26 due to inflation. And things get worse for the people who actually live in countries such as Argentina, Zimbabwe, Sudan, and Venezuela, for their inflation rates are actually above 100%. Well, in this video, I'm actually going to explain to you the causes of inflation and the possible solutions to how you can be financially stable during inflation. The first point is actually an increase in the money supply. When the government or central bank increases the money supply excessively, it can lead to inflation. This is often done to stimulate economic growth or to finance government spending. In order to maintain financial stability, just simply focus on increasing your savings and investments. Diversifying investments across different asset classes such as stocks, bonds, real estate, and commodities can help protect against the eroding value of money due to inflation. The second point is actually demand pull inflation. When the aggregate demand for goods and services exceeds the available supply, it creates upward pressure on prices. Therefore, in this case, the way you can maintain financial stability by adopting a disciplined approach to spending and avoiding unnecessary debt. It is essential to carefully evaluate purchases and focus on essential items, and saving money for the future. The third point is actually cost push inflation. When the cost of production increases due to factors such as rising wages, energy prices, or raw material costs, it can result in higher prices for goods and services. In this scenario, it is advisable you minimize the impact of cost push inflation by adopting cost-saving measures in your daily routine. This includes conserving energy, seeking competitive prices when purchasing goods, and exploring alternatives that offer better value for money. The fourth point is actually the wage price spiral. If workers demand higher wages to compensate for the rising cost of living, it can create a cycle where higher wages lead to increased production costs, which, in turn, result in higher prices. Just simply focus on improving your skills and knowledge to increase your earning potential. Continuous learning, upgrading qualifications, and seeking better job opportunities can help you to stay ahead of inflation and maintain financial stability. The fifth point is actually international factors. Inflation can be influenced by global factors such as changes in exchange rates, import or export prices, and international economic conditions. You can simply diversify your investments globally to minimize the impact of inflation on your domestic economy. Investing in international stocks, bonds, or exchange-traded funds can provide exposure to different economies and currencies, potentially offering a hedge against inflation. The sixth point is actually central bank policies. The monetary policies implemented by central banks, such as adjusting interest rates or buying government bonds, can impact inflation levels. You should always stay informed about central bank policies and make strategic financial decisions accordingly. For instance, during times of higher inflation, it might be wise to consider investments that have historically performed well in conditions such as certain commodities or inflation-protected securities. The seventh point is actually long-term contracts and wage indexing. In some cases, long-term contracts and wage indexing can contribute to inflation. Fixed-price contracts or automatic adjustments based on inflation rates can cause prices and wages to rise. You should always be aware of the terms and conditions in long-term contracts they enter into. Negotiating price escalation clauses or considering alternative contract structures can help mitigate the impact of inflation on financial stability. The eighth point is actually saving and investment diversification. Inflation erodes the purchasing power of money over time. Keeping money idle or relying solely on savings accounts with low interest rates can be detrimental to maintaining financial stability. You should simply consider allocating your savings to a diversified investment portfolio. This can include investments in stocks, bonds, mutual funds, real estate, or other assets that historically have shown the potential to outpace inflation and generate long-term returns. The ninth point is actually hedging against inflation. Inflation-protected securities such as Treasury inflation-protected securities provide protection against inflation by adjusting the principal value based on changes in the consumer price index. You can consider investing in inflation-protected securities as part of their fixed income portfolio. These securities provide a potential hedge against inflation, ensuring that the purchasing power of invested funds is maintained. The 10th point is actually financial literacy and planning. Understanding the causes and implications of inflation is essential for individuals to make informed financial decisions. You should invest time in improving your financial literacy by reading books, attending seminars, or consulting with financial advisors. Developing a comprehensive financial plan that considers long-term goals, inflation, and investment strategies can significantly contribute to maintaining financial stability in an inflationary environment.